talk about today is a little bit about our firm, myself, why I do what I do, and cover just kind of the basics of all the things that we help people with. But my business is unique in that we're able to help people with a lot of different things. And so today I thought it'd be helpful to go in a deep dive on some of the retirement planning challenges that we see, and then talk a little bit about who you guys might be able to refer over to me. So a little bit about myself, like JD said, born and raised here in Fort Worth, graduated from A&M. Had a first career in the hospitality business that started in high school, and that passion for service really translated throughout my life. Mission trips with the church, things like that. But when it came to figuring out what I wanted to do from a long-term perspective, arguably financial planning is one of the most important aspects that I can serve people. And so we already talked a little bit about some of the things that I'm involved in outside of work. We can see them on the screen there. But overall, what we do, our firm has a focus on working with small businesses. So I talked a little bit earlier about that simple IRA. Here's just kind of a list of some other things that we can help people with on that side of things. But on the personal financial planning side, financial planning is very broad and vast, and there's a lot of different things that we can help folks with. So I'm not going to go through all those in detail today, but I do want to talk about retirement planning today. And that's really two aspects: the accumulation side, and that's when we're working and saving. And also, how do we recreate that paycheck once we get to that point? There's a lot of nuance there and some challenges that we see. And so we call it the silver tsunami in our business, but that's really the baby boomer generation. There's over 4 million Americans that are retiring each year. And there's a lot of worry and concern about markets. Obviously, we've seen that so far this year. But with a plan, you can have confidence going into that. So we focus on these retirement planning challenges, and we refer to them as Live It. It's kind of an acronym that I'll go through on what each of those mean. So if you've got notes, take notes. So we good for you guys, so that you can find folks that may benefit from the conversation. So when we think about retirement, most people's biggest concern is running out of money. We know that people are living longer and longer. In 1980, there were 2,500 centenarians. Anybody know what that word means?
100 years old.
100 years old, right? In 2025, there's over 100,000 centenarians. And so with pills and procedures, we know that people are living longer and longer. Whereas our grandparents may have been looking for a 20-year retirement, the challenge is that 25 years, 30 years, because we're going to live longer. We only have so much time that we're able to work and save for that time. And so having a plan is really important to make sure that you don't run out of money. And the way that I think about it is like my grandfather, right? He had Parkinson's disease and eventually passed away, but he had to sell his house because he didn't have enough money to pay for his care. And so that's a big challenge. And we don't necessarily either want to think about being 80 years old and going to be a Walmart greeter. I see those folks and I wonder, are you there because you have to be or just because you need something to do? And so this is a really big deal. The biggest challenge that we have when it comes to the longevity of our money is inflation. If you think about the price of a movie ticket or milk whenever you were a kid compared to today, and that's only going to keep growing. Does anybody know the average inflation rate? Not Brandon?
2%.
2 to 3% on average. So that talks about our purchasing power risk. If our money's not working for us, we're actually losing money every year. So you got too much money just sitting in the bank account, not earning any interest. That's a problem. So we need to think about that. Well, how do we beat inflation? Most people are going to look to investments in the stock market, but that can be a double-edged sword. We have volatility. Like I said, we've seen that a lot this year. Most of that's due to this geopolitical risk that we see with the whole Iran deal. But hopefully that comes to a fix soon. We saw that a little bit yesterday, but there's still some uncertainty. And so it's going to be a bumpy ride once we get there. So we'll look at a case study. Now, when you think about volatility, does anybody have a guess of when that is a bigger deal? When you're saving money or when you're distributing it? Distributing. You're right. So let's talk about Mrs. Green and Mr. Blue. So this is looking at a up market and a down market for Mr. Blue. And so we can see that as they're saving in the accumulation phase, Mrs. Green here, she's starting in an up market. So she's got some great returns those years, all the way down, and the terrible years are at the end. Mr. Blue, on the other hand, down market. Flip those returns, right? At the end of the day, their average return is both 6%. So that's not as big of a deal whenever you're saving money. And it's actually a good thing, right? You think about this market downturn and you're saving for retirement, it's really actually a good thing because you're getting new shares at a lower cost. as consumers, we're good at seeing that, right? We go to the grocery store and we have, we're planning on getting burgers, right? But the ribeyes are on sale, so we get the ribeyes. Stock market's the only store where people run out of the room screaming because everything's on sale. It's kind of weird when we think about it that way. But once we get to retirement, it's a different story. So, same scenario here. Mrs. Green, she starts taking out 50 grand a year from her $1 million in an up market. And she's actually got more money by the time that she passes away and her retirement's over. Mr. Blue, on the other hand, he starts in the down market and he runs out of money. So that's a big deal. How do we manage that? We call that sequence of returns risk in our business. So when we think about volatility, when people are retiring, they're generally shifting their risk in their portfolios and looking for things that are a little bit safer. And so we talk about fixed income in a second, but obviously the volatility can create some emotions. It's not fun to see your portfolio down this year. And it's a big wave, big ride. And so we see that folks are hopeful, they're thrilled, things start going down, get frightened, desolate. That's the part where you don't want to sell, right? You're locking in those losses at that time. And then things come back up. And so it's unique for every person, but as we try to navigate the market volatility and shifting our risk inside of our portfolio, we think about interest rates. So typically retirees are going to look for things like fixed income securities or bonds, right? In the stock market, we think there's really two main sides. There's own it and loan it. So own it is buying stocks. You're owning a portion of a company. And loaning it is where you give your money to a government, municipality, or corporation, and they're paying you an interest rate. So when we think about interest rates, there's two sides of the coin that we can be on. For borrowing money, we want to have low interest rates, right? You're paying less interest over a total period of time. But when interest rates are low, you're giving the government the ability to use your money, and they're paying you a lower interest rate. So it ties back to that purchasing power risk as well. And the silent killer is taxes, right? Does anybody know what the highest marginal tax rate was in our history? Not Doug? 94%. So a quick story I like to share is Ronald Reagan. Back before he was president, he was an actor, right? And so he'd get 100 grand per movie. He only did 2 movies a year because he knew that next third movie, he only gets to keep 6 grand of that 100K. So tax rates change. Before the One Big Beautiful Bill Act, tax rates were scheduled to go up at the end of this year. Now, those are permanent for now, but we're going to have administration change again. We think about Social Security, Medicaid, all these government programs that we hear are going to run out of money. We printed a bunch of money during COVID, and so it's natural to think that tax rates are going to change. So we've got a lot of different diversity in terms of ages in our group, but tax rates are going to go up over time. And so we also think about where we're saving as being an important part of that. So are you going to get the tax deduction now? Is that a good thing for your plan? Or should we go ahead and pay taxes while they're historically low so we have tax-free growth through Roth-style accounts? So having a balance of different assets in these different types of buckets and the way that we can save is really important. Because that gives you more flexibility when you're taking money out later on down the road. I think my last presentation, I went more of a deep dive on this side. But there's different ways the IRS allows us to save, and it's unique for everybody. And it really depends on how much money you're going to be taking out in retirement of where you should be saving now. So how do we help people manage money? There's a few different options. So option 1, we've got unlimited investment options, average cost. You're going to ride the market. There's no protection or guarantees built into these types of things. The only ways that we can hedge are with cash, bonds, and alternatives. We have another option that allows you to protect from some of the downside risk. You're going to have lower costs in this type of plan. The downside is you can be capped on your upside growth. And so how do we manage a portion of the portfolios to protect from the downside risk while also allowing them to have market participation when the markets cooperate the way that we want? Downsides of these are there's decreased liquidity in these types of accounts. Option 3, do we need to create our own pension? Those aren't as common these days. We know that Social Security, TRS for our teachers, that's not going to be enough to fund your retirement. So we know that we need to save on our own during that time. But we have options to create our own personal pension. These come with higher costs, more decreased liquidity, and you're a little more limited on your investment options. The good thing is that these aren't mutually exclusive. So for a lot of our clients, we're talking about the blend of these options in order to protect what's important, make sure that they don't run out of money, navigate interest rates, inflation, volatility in the markets, and taxes. So here are some great referrals. For retirees, professionals that you know, doctors, attorneys, accountants, people who have just inherited accounts, and young professionals that want to make sure that they're planning for this now. Compound interest is the 8th wonder of the world, so it's never too young to start, even if you think that you don't have enough money to start investing. So reach out to me, connect me in a joint text message with people you know that may benefit from the conversation. I'm not sure if I can help everybody. There's not a good fit sometimes for the folks that we meet with. We specialize in people that are taken care of as well. So if they already have someone that they work with, it doesn't hurt to look under the hood and see if there's any value that we can add. So I appreciate your time.
All right, thank you, Howard.